Bonjour à tous, bienvenue.
Good afternoon, ladies and gentlemen, and welcome to the presentation of our half-year earnings. I will continue my speech in English because there are some listeners who do not speak French.
Presentation of the half-year results of AXA for 06. This will be, as usual, a presentation made by the board of AXA, and especially by Henri de Castres, his chairman. So, Henri. And it will be followed by questions, obviously.
Thank you, Etienne. Good afternoon, everybody. Welcome here. Despite the fact that it's early August and that probably most of you are aspiring to do other things, it's just listening to earnings presentations. So let's go through the presentation of these half-year earnings. The first thing I want to say is that we as a management see these earnings as being good, very strong, and boding well for the future. They are satisfactory under three aspects. The first one is that in terms of revenues, the growth is there, and the growth is there everywhere in terms of business lines and everywhere in terms of territories. You know that as part of the Ambition 2012 business project, we aim to double the size of the group organically between 2004 and 2012. For that, we need to reach certain growth, specific growth hurdles in the three key components of the business: property, casualty, life, and asset management. When you look at what has been achieved over the first 6 months, it's strong. It's even an acceleration when compared to 2005. And it's ahead of what we need to do to reach the 2012 targets. So it doesn't mean that 2012 targets are easy, but it means that they are realistic and that the business is shaping up in a way which makes them very credible. So revenue growth is the first positive aspect of this semester. The second very positive aspect of the semester is the fact that the profitability has been increasing everywhere in all the three business segments, and that this has, I would say, driven the very strong underlying earnings and the very strong adjusted earnings growth. Profitability has increased on the back of the volumes, but also because the margins have increased. If you look at the property casualty combined ratio, or if you look at the margins in life, they are better than what they were last year. Last but not least, because Building the Future is not only developing the existing operations, it's also changing the perimeter of the group. We think that what we've done over the first half of the year is, I would say, increasing the growth profile and reducing the volatility of the group earnings. And I'll come back to that into slightly more details. Going back to the growth, you know where we were last year, 11% in terms of annual premium equivalent for the life business, 3% on the property casualty side, 14% on asset management. You know also what we need to do if we want to reach the 2012 targets. We need to be close to 10% in terms of annual premium equivalent growth. We need to be between 3 and 5 on the property casualty side, and we need to be over 10 on the asset management side. What did we do for the first half? Significantly more than that. The growth has accelerated on the life and savings side. The growth has accelerated on the property casualty side, despite the fact that many people see the cycle as peaking. It's true that the business is more tense, but our product offer and the efficiency of our distribution is such that we are gaining ground there. And on asset management, we really had stellar first 6 months with both Allianz Capital, Allianz Bernstein, and AXA Investment Managers doing extremely well. So on the back of these very strong revenues, the earnings have grown very significantly. If you start by the life and savings business, the new business value is up 30% at 670 million euros. It's a very satisfactory growth rate. It's generated by volumes, by better margins, and it's the fruit of the efforts we've done over the last years to increase the efficiency of the operating models in all territories, including those where traditionally the margins were less good. And as I said before, the margins have been improving by 2 points, putting us in a very satisfactory situation. On the property casualty side, the combined ratio is improving further, despite the fact that the reserving policy remains extremely cautious, would I say. It's true that if you look at the details, the expense ratio is increasing a little bit, but the very large part of this increase is due to a change of business mix. We are attracting business with higher commissions and better loss ratios. At the end of the day, it leads to a lower combined ratio. There is 1 point, which is the increase in administrative expenses. It's an increase of 0.1 points. We would have been more pleased to see that at lower levels, but I don't think it's a major issue, because the key point for me is to see the combined ratios decreasing with a very, very satisfactory reserving situation, and it's what's happening. On the asset management side, as I said, the performance at both AllianceBernstein and AXA Investment Managers is extremely strong. The volume of assets they have gathered is reaching all-time highs, with something which is close to 40 billion euros. I don't think there are a lot of institutions worldwide having collected as much over the first semester. This is driven by their very strong investment performance, and there too by the efficiency of their distribution organizations. Their cost-income ratio, helped by the level of assets and the strength of the cash flows, has been improving further, and now both AXA IM and Allianz Capital have cost-income ratios at approximately 70%, which we see as being quite good. All this is leading to a strong increase in underlying earnings, 19%, so very well aligned with the very significant growth rates we've been seeing in the last years. And I think it's very important to look at that, because at the beginning, when throughout the turmoil, we were generating 20% underlying growth, underlying earnings growth, some of you were saying, okay, fine, this is part of their restructuring programs, but what's going to come after that? Are they going to be able to generate underlying earnings growth once the restructuring phase will be over? I think we are demonstrating that, driven by a very sound growth in terms of revenues, underlying earnings are progressing quite well. Adjusted earnings are progressing even more strongly. This is, of course, the outcome of the fact that we have kept a significant exposure to equity investments, which are enabling us in the long run to extract better investment performances. We have extracted in the first half more than 800 million euros. You know that we've given, when we were publishing our full-year earnings, a guidance which was that under normal circumstances, what we would expect to extract from our equity portfolios was something between 600 and 800 million a year. What you see there is the fact that in the first half, we have secured slightly more than what the full-year target was, which means two things. I mean, it doesn't mean that it's going to stop there for the full year, but it means also that we do not intend to multiply by 2 the 800 million you are seeing here. The conclusion you should draw from that is that we are in an extremely comfortable situation to speak about the dividend policy, because we think that the strength of the earnings is putting us in a situation where we will deliver satisfactory things in terms of dividends for the shareholders. If you look at the change in terms of perimeter, which was the third point I was mentioning at the beginning, during the first half, the teams have been quite busy. There are acquisitions which have been completed during the first half, and there are acquisitions which have been initiated during these 6 months. We have completed the acquisition of the Winterthur businesses in Canada. It's an integration going extremely well. I would even say it's largely over now, and it's a very satisfactory one. We have acquired MLC in Hong Kong, which is a very nice market share addition with significant cost synergies. There too, it's working quite well. We have continued to develop the business on the asset management side in both China and India, which are for the future two quite promising markets. We have kept on doing what I would call the house cleaning by buying out the minorities in Germany. Not a major thing, but it's something which is now behind. And last but not least, it's probably strategically the most significant element. We have divested and we have completed the deal, the reinsurance operations, and this, I mean, we have achieved, we think, a very satisfactory outcome as far as the price of the transaction is concerned. And going forward, we think this is going to reduce the volatility of the earnings, even if AXA Re was a very well-managed company, which we think is going to have a great future under its new ownership. But at least, I mean, it's now creating a fully clean picture for the group, and it's going to save for Stan, Denis, and myself probably 25% of the questions you were raising on something which was representing only 3% of the activity. So because we are very lazy, we thought we had no other solution than to dispose of this business. Going forward, we are now embarked on the Winterthur acquisition. We think, I mean, the more we go, the more we are convinced week after week that this is a great move. We were convinced initially that this was a great move because if we hadn't been, we wouldn't have done it. But we think the fit with the Winterthur teams is a great one. We think it's a well-managed company. We think the turnaround which has been achieved over the last 3 years is a very impressive one. We think these are high-quality operations, and we think the integration is going to work quite well. And as we've said during the initial presentation, people should not underestimate the strategic importance of that move because it's very significantly increasing the profitable market shares we have in the places where Winterthur is active, and it's on top of that giving us a very nice exposure to the Swiss market. Additionally, what I would say is that for those of you who have looked at the Winterthur earnings for the first 6 months, I think they have the answer as far as the growth and the profitability of the operation is concerned. So going forward, I think, I mean, we have by that increased the benefits of the globality of the group. We have now quite efficient global platforms. We think Winterthur is going to add further to that, and we think that because this deal is very significantly dilutive, it's going to be looking backwards, seen in a short period of time as something which will have been a very good move for AXA and for its shareholders. Having said that, I'd like now to turn the floor to Denis, who is going to go into more details as far as these good numbers are concerned. Denis.
Thank you, Henri. Good afternoon or good morning, everyone, depending on whether you are on this side of the Atlantic or on the other side. I will now go into more details of the presentation of our financial performance for the first half of 2006, and start with the growth aspects of the business. On the life and savings and asset management, we experienced, as Henri told you, very good growth with the new business annual premium equivalent up 17%, and unit-linked products up 28%. They now represent 49% of the APE versus 46% last year, so continued growth of unit-linked business, which explains a part of the increase in the margins, which Stan will comment on later. New business value up 30%, an increase in margin of 2.2 points, and increasing net operational cash flows, net inflows in our life and savings business from 5.8 billion euros to 6.8 billion euros. So this is a business which accumulates assets on a consistent basis and I would say also on an accelerated basis. On the asset management side, our revenues went up 31%, driven by higher average assets under management, up 19% from the previous year. And the proportion of third-party asset management is increasing, especially on the AXA Investment Managers side. The net inflows were 39 billion euros against 16 billion in the first half of last year. For AXA IM, there was some acceleration, but a big acceleration was noted on the AllianceBernstein side, where the net inflows were quite modest last year, and they represent 23 billion euros this first half, which is quite outstanding performance. Moving to P&C on the next slide, good performance in P&C in a competitive pricing environment, demonstrating our ability to continue to grow revenues in that environment. On the individual line side, revenues were up 4% with more than 500,000 new, additional contracts on motor, and almost 150,000 additional contracts on households, and commercial lines were up 3%. Cash flows, operational cash flows, which allow us to have improved investment results, have been fairly stable at 1.5 billion euros, but it's 1.5 additional billion euros, which allows us to continue to generate additional investment income on the P&C portfolio. So when you look at the various business segments that we have, you see a very strong growth in earnings across the board, with one exception, which Henri mentioned briefly, which is international insurance. In this segment, we have AXA Re, which stopped generating earnings for us because the 2006 underwriting year is for Stone Point, the acquirer of the AXA Re business, even though the transaction will only be completed around year-end. And AXA Re last year had 55 million of underlying earnings, so that explains the decline. Asset management was the strongest performer, life and savings very strong as well, P&C quite strong. Moving to P&C, our underlying earnings were up 12% at 780 million euros, a record, boosted by continued combined ratio improvements and continued investment income driven by the flows improvement as well. What is remarkable is that our combined ratio went down in all geographies to 96.9%. And this is made up of two movements in different directions. The loss ratio went down by 1.7 points, and the expense ratio went up by 1.1 points. I will comment that in a minute. This has driven an improvement in the underwriting results, and the flows, the net cash flows have driven a significant improvement in the investment income, which explains the plus 12% that we register on the underlying earnings for P&C. The better combined ratio can be broken down in several components. On the loss ratio side, we have a better claims experience in the UK and Belgium, and positive prior developments, especially in France and Germany, but I would say across the board. In fact, the all accident year combined ratio is 4 points better than the current accident year combined ratio, and this is true this 4-point difference is true in 06 as well as in 05. So on this slide, there is a comment which is specific to France and Germany, but in other years it was other territories that showed the better performance there. So we don't have more positive developments in 2006 in P&C than we had positive developments in 2005. The loss ratio improvement reflects also a change in the mix of business towards business with lower claims and higher commissions. And you find the flip side of that in the acquisition expense ratio, which increases by 1 point and reflects the fact that we are paying higher commissions. The admin expense ratio moves up by 0.1 point. But this is really the effect of a change in expense allocation. You see at the top of the slide that claims handling ratio moves down by 0.2 points. So there is a reallocation between claims handling and admin, which you shouldn't read too much into. It's just that we are refining our cost allocation method to reflect it in the most economic way. So what you should take out of this is that in this competitive pricing environment, we are able, as we told you, to continue to manage our combined ratio in a very satisfactory way, and is going down in a business where we continue to gain market share. The other aspect that I want to emphasize on this slide is that we have a stable ratio of reserves to premium, and we have a continuously increasing ratio of reserves to claims paid, which means that, as Henri pointed out in his introduction, we are not reducing, not changing the way we reserve our business, and we are, I would say, reserved in a way which is prudent. On the international insurance side, the divestiture of AXA Re reduces further earnings volatility. The flip side of that is that we had positive earnings in 2005 in the first half for AXA Re, not in the second half, and we don't find these earnings appearing this year. As you know, the 2006 underwriting year goes to Stone Point. The 2005 and prior underwriting year results go to AXA. We had a positive development of 4 million euros in the first half of 2006, which you can find in the other international line, which moves from 9 to 20 million euros. On AXA Corporate Solutions Assurance, which is the largest, the bulk of the business in this international insurance segment now, revenues were up 4% on the back of property portfolio development. We had a flat combined ratio at 100.5%, and the investment income has seen good growth driven by the higher asset base. On the asset management side, we have a good assets under management resilience thanks to the strong net inflows that I've showed to you earlier, despite flat equity markets, negative bond markets, and I would add something which is not on the slide, which is an exchange rate impact, which was unfavorable because the dollar appreciated versus the euro, and this has a small impact. So year on year, you see a significant positive development between average first half 2005, 774 billion euros, and average first half of 2006, 944 billion euros. You see an almost flat development of assets under management between year-end 2005 and mid-2006 because of the market movements that I've just mentioned. The other point to note is that the third-party assets under management continue to grow substantially, whereas the assets managed for the group insurance companies are fairly flat because of the movements I have alluded to earlier. Going into more detail on asset management, you see on the left-hand side of this slide AllianceBernstein, and on the right-hand AXA Investment Managers. You see that on the AXA IM side, the proportion of third-party assets under management moved from 26% to 34%. Both companies, both asset managers have benefited in the first half thanks to good revenue growth and strong expense discipline, a decline in their cost-to-income ratio to around 70% for both companies, which shows, as far as AXA Investment Managers, that the company is becoming more mature as it can reach a 70% cost-to-income ratio. On the underlying earnings side, you see plus 32% for AllianceBernstein and a phenomenal plus 71% for AXA Investment Managers, which is showing the growth that we presented to you in April in our special Investor Day. I will now hand over to my friend Stan Tulin, who is going to make one is last excellent appearances on this podium, because as you know, and as we all regret, Stan will retire at the end of the year, so he will show his best today.
I meant to limp over here, or crawl. So thank you, Denis. And turning to business, green? Green, okay. So I just wanted to know where, so the life and savings business was driven by margins across, all across. Wait, whoa, back up. How do we back up, guys? Back up. Further. I think Denny advanced this. Good. Stop. Thank you. Okay. So I'm going to take you through the 24% that both Henri and Denis have mentioned already, and do it in a little bit more granular way by country, with a little bit of understanding about what happened in each of these. But again, the key message is that our growth and underlying earnings in the life business was really across the board. The U.S., you see, was up 20%, driven by really the fundamentals in our business that we've been working on a long time. A lot of unit-linked business, driving a very significant increase in fees and revenues, over $100 million. Our investment margins were up largely because of superior real estate performance on a fairly small real estate portfolio, with our still suffering from margin compression that's being caused by the lower rates. So as rates have edged up a bit, that's actually helping us in the U.S., and you'll see that manifest itself in our new business margins. And then finally, we had a higher technical margin due to both the hedging program on IB and DB doing very well in the first half, and also mortality experience. With respect to France, you see France was up 24%, really great performance, driven by fees and revenues that have emerged from the change in mix over the last several years to more unit-linked business, and that continues to bode well and also drives their significant increase in new business value. With respect to Japan, you see that it was actually up 12%, and that's driven by higher investment margin and higher fees and revenues, all flowing from the new business that's really been sold over the last 5 or 6 years. But more importantly, in terms of understanding Japan, and for that matter, life and savings, is you might recall that last year in the first half, we actually had 47 million of one-time positives that were actually 4 different places in the earnings that I'll take you through in a moment. So if you adjust for that, which we told everybody at the time were one-timers related largely to the deferred tax asset, then the growth in Japan was actually 83% for the first 6 months of 06 over the first 5 months of 05, or 6 months of 05, and that is quite real. So that's really apples to apples and a very fair comparison. You see APH, AXA APH up 31%. Strong technical margin in both Australia and Hong Kong, strong fees and revenues due to both market inflows as well as market performance, and then slightly offset by an increase in commissions. The UK, we've actually got real increase in the UK life. I would say, I think it is timely because it's my last appearance. I think it's the first time since I've been making appearances that we have a significant improvement in the life business in the UK, and it is real. There are actually 3 one-timers in the UK numbers, but they actually work out to be worth 0. So what we really have in the UK is very strong increase in fees and revenues from strong bond sales and strong pension sales. And again, as I mentioned, the offsetting one-timers all around 0. Germany, we're actually starting to see the life business in Germany improve, strong fees and revenues, and an increase in the investment margin. This is, for those of you who have been listening to me on this for 6 years, it's a significant percentage increase on a very small margin. So it's gone from 36 million to 44 million on some billions and billions, over 20 billion of reserves. But it's the beginning, and it's actually coming from tightening of the credited rates, and I think there's, that this bodes well for the future there. And then finally, in Benelux, it's kind of flat. Sales this year are not up as much as they were last year. And the other thing to remember about Belgium is that Belgium is one place where we actually have a higher than average allocation to equities, and that manifests in lower underlying earnings because the equities then deliver through capital gains. And in fact, if you look at Belgium's adjusted earnings for the first 6 months, they were 254 versus 63 for the first 6 months of last year. And that reflects, again, the overweight to equities in Belgium, which is driven by a number of reasons, including tax. Now I can push the green button. Okay, there we go. So again, it was driven by all margins, and now what we do is we go to this fun chart. So this is something we came up with a few years ago, and I hope this helps you in terms of understanding what's actually happening to us. So the message here is that our investment margin, due to compression, but then offset by larger assets and good investment performance in real estate and other markets, our investment margin was actually up 7%. The fees and revenues up 16%. And technical margin, basically what we're doing in the life insurance business, morbidity, mortality, and other charges up 26%. And expenses were actually only up 8%. That's operating leverage. If we can keep doing that, which we have been doing, that drives earnings. And if you look at the next part of this slide, basically the composite growth in revenues, investment margin, fees, and technical margin was 15%. Again, the expense was 8%, and that is, of course, what in turn drove, in this slide, a 30% increase in the earnings. Now, why is it 30% versus 24%? And the answer is because in this slide, we've adjusted out the one-timers in Japan from last year because it actually makes a more coherent slide. Okay, had we used the same numbers for Japan, you'd get different numbers, but it would still conclude at 24%. Instead of the tax going up a lot, 29%, the tax would have gone up much, much more because last year we released some 188 million euros of tax reserves in the, back into earnings. That was the nature of the one-timer. So moving on, we now take a look at really what drove these things. And again, the underlying investment margin was helped by higher general account balances, increased in dividend yield. So we made a move in our equity portfolios to move towards more of a value orientation with higher dividend yields. And I actually think that's paying off probably not only on this side, but also in the capital gains. But it certainly creates, I would say, less volatility. The fees and revenues are up 16%. And that's really driven by all of the things that we've talked about. It's insurance fees and loadings were up 13%, driven by business in the U.S., France, and now in both the UK and Japan. Health revenues up in both Germany and Japan. And then mutual fund revenues continue to rise in Australia, and all those things come through fees and revenues. And then finally, on the technical margin, we were up 26%, and a big portion of that is coming from the U.S. And what we're doing in the DBIB spread. On the expense side, the growth of 8%, part of that is commissions, which you would expect. Part of that is increased DAC amortization, which will follow increase in fees. So it's expected, and it's actually positive for that to occur. But again, if you have the revenues growing at 15 and the expenses growing at 8, you have a very good business. And by the way, if the earnings grow at 30%, it's not surprising that the tax will grow at some number approaching 30%. That'll perhaps be a passing concept for everybody. Just teasing. Okay. Green button. Good. So the separate account, this really follows more or less what Denny just showed you with respect to the asset management businesses as well. We've had very strong cash flow around the world in the life insurance businesses, but the markets have not helped, and for that matter, the foreign exchange has not helped in the last, in this part of this year. So what we find ourselves with is that the June 30th asset balances actually were equal to what we averaged for the first half of '06. Message on this is not negative, but it simply is that if the market were flat for the rest of the year, then in fact our fees and revenues for the rest of the year would be flat to what it was for the 6 months, except for whatever we deliver in increased cash flow. And again, we have been delivering that, but these businesses do better when the market is going up. And that's the real message there. At the bottom of this, you actually see that our separate account balances as a percentage of all of our life and savings gross reserves are actually now up to 37%, which is impressive given the size of what we had to grow from, and moving it is significant. Now we move into new business value, and here I was supposed to say that so this was like giddy American concept that we were glad to regain the #1 position, but actually it didn't matter that much. So you can see, though, that the U.S. is now, again, the top at 211, Japan at 182. I'm going to take you through the details of these and try to give you a little bit more granularity and understanding with respect to them as we go through this. So you can actually see, again, though, if you look at the total, that at 670, and this has only been mentioned 3 times, but I think it's important, we're up 30%. When we first started calculating new business value, that was about what our new business value was for a full year, and now we're able to deliver it in 6 months. And you can see, as we've mentioned, that our margin has increased by 2 points. What I think is actually even more important is that our margin has increased 2 points while going down in Japan and Hong Kong, where, frankly, we've been saying for quite a while that we thought those margins would have to go down. So what we're able to do is increase the margin overall at the same time that I would say we're rationalizing it by having more competitive products in some of these other places. So now if we just look at a few of the key countries, the U.S., you see, was up by 56%. I'm going to deal with that on the next slide. Japan we'll also deal with on the next slide, France, and then finally the UK. So let's talk about Benelux. It's mostly volumes and hurt a little bit by the yield curve. So that's what's really going on there. Hong Kong is all about volumes. The growth there is entirely driven by volumes. And again, there, the yield curve actually has hurt us. And Germany, I think, is an interesting story. You see that Germany now has NBV up 50% to 23 million. So it's not a very big number, but represented in that 23 million is 5.6 million of new business value on the Twin Star product, which is basically the German accumulator or the German variable annuity. So I think this is a good sign and something that should bode well for future growth in our NBV. Now, if I go to the next slide, what I'm actually going to do here is kind of roll forward from the 512 to the 670 and take you through the pieces of that. We had modeling changes that actually improved the modeling and reduced the value. Most of those were in the U.S., by the way. But then if you look at the next big jump, 137 million of the increase basically came from volume and expense improvements, slightly offset by mix. And mix was actually very good most places in the world, but bad in Japan and the UK, which I'll talk about in a moment. So overall, mix was actually a slight negative to us, but it was positive in France, it was positive in the US. The next column basically shows that we had a 22 million euro pickup from the risk-free rate. Now, I noticed in one of the commentaries I read about today's release, that this was described as a change of assumptions. This may be a detail for those lovers of market-consistent embedded value, but this is not an assumption. This is the reality of the interest yield curve. This is exactly what we're supposed to be doing. We may be the only ones in the world who do it, but it's not a change in assumptions whatsoever. It's a change in the yield curve. And one of the things we talked about in February when we did the full year was that interest rates had hurt us in the US, particularly on our secondary guarantees. And what we've now had is a 70 basis point increase in the risk-free rate in the US. That's actually helped us. That's the bulk. In fact, it's more than 100% of the 22 million that you're looking at. But at each place in the world, we've actually restated the risk-free yield curve to reflect where it was basically at May 31, and that's what's driving these numbers. But again, it may be just actuarial ticklishness, but it is not a change in assumptions. It's just whatever the environment is. And then finally, you see the foreign exchange impact of 4 million. So my last slide is basically what I promised, which is a little bit more detail. So it's a kind of a mini roll forward, US, Japan, France, and the UK. And again, here you can see that more than 100% of the 4 million in modeling changes, 7 million of it came from the US. It had to do with the way we were treating our investment management fees in terms of the calculation of our options and guarantees, and we think this is a more appropriate way to do it. You can see what it did was reduce our value. But then we picked up 19 million from volume, strong sales in the variable annuity business, and a very significant improvement in mix as we basically reduced further our sales in the fixed annuity marketplace and have actually been selling more profitable life products. In the next column, you see the risk-free rate, and again, that's 35 of what you saw on the prior slide of the 22. This is actually in two pieces. So a piece of this is coming from the increase in the risk-free rate, helping us and making the cost of the secondary guarantees lower. For those lovers of, again, European embedded value, market-consistent embedded value, a higher risk-free rate, if you don't change the secondary guarantee, has to make the cost of the secondary guarantee less. I hope that appeals to everybody. At the same time, we actually had something that slightly offset that, which was an increase in the guaranteed rates on the money that stays in the fixed account on our annuities. That went up to its statutory cap of 3%. So it can't go any higher. It could go down, and that would help us, by the way. But at the same time it was going down, we would probably be getting a reduction in the risk-free rate. But the point here is if the risk-free rate goes up more, you should actually expect to see an even bigger improvement in the U.S. with respect to new business value. And then finally, you see the FX impact for the U.S. of 6 million. If you look at Japan, the volumes, as you all know, I think, were very strong in Japan, but the mix was not as good. They were selling a product that was highly profitable in the health business that was very much supported by the tax code with 100% tax deduction. It's now a 25% tax deduction. It's slowed down, and that in turn reduces the high margins that we had on the health products. The margins are still quite good, as you saw, but that drives the minus 36 in mix. So we had plus 52 million in volume offset by 36 million in mix and a plus 13 million from further expense economies. The risk-free rate, and it's really more the shape of the curve that actually created a negative result for Japan. and then finally a slightly negative foreign exchange impact. If you look at France, it's really a story of everything working. Volume increasing the new business value mix, very positive move, continued move to unit linked, and then finally positive on expenses. And here the offset is that in France, the balance between unit linked and fixed is still such that when interest rates go up, fixed margins, if you will, technical margins, get discounted at a higher rate, and that simply is what's reducing the NBV by 7 million. Then finally, if you look at the UK, what you see is actually volume helping, offset by mix. We're selling a lot more pension business in the UK, as is everybody else, but it's lower margin. And we did have a significant improvement in expenses, and that results in the real increase that we've seen in the UK NBV. So, Denny, it's your turn, and I'm not going to say anything nasty about you. Other than thank you, everybody, for your patience lo these many years. So.
Thanks, Dan, and you lived up to my expectations, if that's what you wanted to know. So, moving to the next slides, which goes from underlying earnings to net income. I will not comment all the figures on those slides, on this slide, but maybe three things. First, on the right-hand column, you see the movement on a per-share basis. Underlying earnings up 21% per share, adjusted earnings up 39%, and net income up 23%. You see that there is a difference, a positive difference on a per-share basis of 2 to 3 points compared to the growth in absolute numbers. This is exactly what we had told you at year end, which is that through share buybacks and the AXA-Finaxa merger, we created at year end 2005 an accretion for a natural accretion for the next year's earnings. You won't see that in the second half because we will have the new shares issued for the acquisition of Winterthur, but we start the year with an accretive position which is showing in those numbers. Second point is a comment on the capital gains. You see that our capital gains have moved from 370 million euros in the first half of 2005 to 826 million euros in the first half of 2006. When you look at it more in depth, this is the combination of two aspects. First, a foreign exchange element, which is that in our portfolios, when we have, for example, US dollar equities, even if we don't realize if we don't sell the equities, if we hedge the equities from a currency standpoint, all the mark-to-market of the equity, currency hedge, goes through adjusted earnings. And we have a change of 138 million there, there was a negative last year and a positive this year, which is linked to the appreciation of the US dollar. Second, so in fact, the capital gains, excluding this foreign exchange impact, have moved from 318 to 764 million euros. So that's my second comment. The third comment relates to the movement from adjusted earnings to net income. Our adjusted earnings grow 37%, while our net income only grows 20%. The reason for that is the impact of the changes in fair value of mutual funds, bond mutual funds through the P&L, and changes in the fair value of interest rate derivatives, which go through the P&L, while and those interest rate derivatives are backing, the debt, which is not marked to market, whereas the derivative itself is marked to market. So those changes which affect the P&L represent 275 million negative compared to a plus 119 positive last year. Exceptional operations were 27 million last year They are 92 million this year, the bulk of that being dilution gain on AllianceBernstein units. Those are the comments that I wanted to make on these slides. And now I will move to balance sheet and capital. Turning to slide number 30. The net income in the first half of 2006 was more than offset by the decrease in the fair value of assets recorded through the shareholders' equity as a result of increased interest rates. We start with, at year-end 2005, 33.8 billion of shareholder equity, and we go down to 31.7 at June 2006. The first movement, which is the second bar on this chart, is minus 2.8 on the change in the fair value of assets. So the fair value of assets, which is the bonds and equities, moved from 8.2 to 5.3 billion. It's a negative 2.9 billion euros. And this is obviously not something which reflects the economic reality. If we try to have a better picture of the economic reality, you need to look at this in more detail. First, there is the bond portfolio which matches the PNC, and in this bond portfolio we have a negative 1 billion movement in the fair value of the bonds. This is a real economic negative, so it's minus 1 billion. Then we have two other movements which are not reflected here, which is the change in the European embedded value or present value of future profits. And we don't publish embedded value at mid-year, as you know, but we had published at year-end some sensitivities. Interest rates have gone up 70 basis points. And if you look at the sensitivities, that would translate into an 800 million increase in the European embedded value. And the third movement, which is not reflected here, is the change in the fair value of the debt. With the increase in interest rates, the fair value of the debt has increased by about 500 million. So in fact, the true economic picture would be something like, instead of minus 2.9, plus 0.3 billion. I will make one further comment on the fair value of the debt, which is that when you look at the European embedded value, our European embedded value is measured on a post-tax basis. And when some of the analysts are looking at the fair value of the debt, they may have forgotten that the debt is not tax affected. Our interest rate on the debt is pre-tax. So I believe that there needs to be an adjustment to our economic value by tax affecting the debt that we have on our balance sheet. The third column is currency fluctuations, negative 0.6 billion, positive then the 2.7 billion of net income for the first half, a negative 1.6 billion for the dividends, 300 million of share buyback, and 600 million positive of other elements, the biggest of which is the decrease in the fair value of our pension liabilities. So what I take out of this slide is that there is a negative movement in our shareholder equity, which does not reflect the economic reality, because I would say that based on my earlier comments, the value of the group has increased during that period. Moving to the next slide, more granularity on the unrealized capital gains attributable to shareholders. We are moving from 11.8 billion euros to 8.8 billion euros. You see how we build that, 2.2 billion euros of unrealized capital gains on the AllianceBernstein shares, 5.3, which I've already mentioned, of fair value of the bonds and equity portfolio, and 1.3 billion euros of unrealized capital gains not reflected on the balance sheet on the loans and real estate portfolio. Moving to the next slide, we have continued to deleverage our balance sheet with the debt-to-equity ratio moving down 1 point from 38 to 37 points at the 30th of June. So this is a good move. With the Winterthur acquisition, the debt-to-equity ratio, the gearing, would, as we indicated earlier, increase by 2 to 3 points to go back to 39 or 40%, as we indicated when we announced the Winterthur acquisition. This gives me a good transition to give you a brief update on Winterthur. Just a reminder on the financing and an update on the financing. The total consideration for Winterthur is 7.9 billion euros, plus the refinancing of 1 billion euros of debt. We have completed the capital increase of 4.1 billion on the 13th of July. It was heavily oversubscribed and successful. We have also completed the raising of 2.2 billion euros of TSS, the deeply subordinated debt, in 3 tranches, 1 euro tranche and 2 sterling tranches. This was done on July 6th, and this was also quite successful in a market environment which was fairly difficult at the time. Moving to the next slide. This slide doesn't tell you much because we are mindful of all the legal precautions that we have to take. But what you should take out of this slide is that the planning of the Winterthur integration is moving quite satisfactorily. The teams are already at work. We've organized the integration planning at the end of June. We have launched the projects with local integration teams, including asset management and head office integration, and transversal integration teams to look at the various activities that we want to develop to take advantage of the AXA Group leverage. And we are moving ahead as fast as possible in the preparation of the closing, which we still believe we should be able to do around year-end. We are well advanced on the necessary regulatory filings, including European Commission, Swiss, and US. And we are using clean teams to make sure that we continue to operate as separate groups during the periods when we don't have secured the regulatory filings that are necessary to complete the transaction. I will now hand over back to Henri, and I thank you for your attention.
Thank you, Denis. And now the outlook. What are we looking for the end of the year? Well, I think things are quite simple and quite positive. The performance for the first half of the year, as you've seen it, is a very strong one. The momentum we are showing entering into the second one is also a very good and a very strong one. So we have a strong momentum in terms of revenues, and the little market turmoil we've seen in May and June, as Denis has mentioned, didn't affect very much didn't affect the volume of the business we've been taking. And what we see in July is, from that standpoint, very comforting. So revenues, strong momentum. If we look at the combined ratio, we are pretty confident that, except if there are, as usual, major catastrophes between now and December, we will have in 2006 a combined ratio which is going to be better than what it was in 2005. So if I was a little bit aggressive, I would say for the third or fourth year in a row, we are going to prove a couple of people, and a significant number of people, wrong, who every year when we show a good performance in property casualty tell us it's going to worsen next year. It's not true. It's going to get better for 2006. Next point, in terms of new business value, we are pretty confident that we are doing the right things to continue to keep a strong momentum. So I think when we look at 2006, once more, provided there are no major catastrophes, we think it should be another good year, strong year, very strong year for the group. Of course, as we've already said, we do not expect to double the amount of realized capital gains since we have already extracted 800 million in the first half of the year. When I look at would say at the picture overall, and when I put that in perspective with our 2012 ambition, I think what we can say very confidently is that we are very well on track, and that what we expect to do is really to deliver in terms of earnings per share growth, so including the new shares we have issued, what we have said we would do as far as 2012 was concerned. So the group is in good shape. The revenues are growing. We are gaining ground in the markets where we are. We have a very strong balance sheet. We have the necessary flexibility to develop the operations further, both organically and externally if there are opportunities. This is the message, and I think we'll now go to the questions. Thank you very much. Either in the room or on the phone. Yeah, in the back of the room.
Yeah. Thomas Jacquet, Chevreux. I understand that we have to be prepared to see higher cost ratio in P&C. Could you give us more insight on what business did you enter into, especially in the UK, the high commission business? And do you plan to make other significant marketing campaign in the future? My second question regards new products. Can you give us an insight on how much of the growth is coming from recently launched products? And my third question is regarding solvency. You don't give any figure. Could you please make an update on this? Thank you.
Okay, Denis?
Yeah, on P&C in the UK, you have essentially two things happening. First, we are doing more partnership deals with affinity groups. And second, and this is particularly the case on the creditor and travel business. And the second, we are doing more deals with large brokers who have a very good track record in terms of loss ratio, which we have to compensate by higher commissions. And so this is for the UK. And in other countries, particularly in Germany or Belgium, we also increased commissions slightly to secure a better business. So that's a trend that, as you can see, both in the UK on one hand and to a lesser extent in Germany and Belgium. Your second question on new products is one which is difficult because there is not a single answer. But anecdotally, we can tell you that the new products that we've launched have been generally quite successful. I don't think it makes sense to say that they represent 10%, 20%, 30% of the value of new business. But generally, I would say that we are better equipped to launch new products successfully, both from a product technology standpoint and from a marketing standpoint. And I'm quite confident that this trend will continue in the future. Maybe one more comment. We are pleased with the initial success of the launch of the Twin Star product in Germany, the variable annuity with secondary guarantees. And as we told you, we expect to launch similar products in different flavors in the rest of Europe, essentially at the beginning, by the end of this year or the beginning of next year. Finally, on solvency, we remain in a very good solvency position at the mid-year. Obviously, the solvency is negatively impacted by the increase in interest rates because that's what's happening across the world. And as you know, in the European solvency margins, you count the unrealized capital gains on bonds in your solvency position, even though from an economic standpoint, it's not, it doesn't make a lot of sense. This is effectively the case. So we had a negative impact of the increase in interest rates. Does that answer your questions?
I'll just add something as far as new products are concerned. I think that I would say a better use of reinforced marketing capabilities is susceptible to generate additional growth. If you look at the example of the recent initiatives we have taken in France with the ad campaign François and his teams have been doing, if you look at the recent example of the motor business in Germany, if you look at what has been done in Belgium, we think there is further improvement to come out of the marketing arena within the group. Next question. Yep.
Yes, I have just one question about the technical margin, the strong improvement you record, in particular in the US. I didn't understand very well the driver of this improvement on the GMIB, GMDB. Is it because you recorded an improvement of the mortality experience, or it is because there's a lower cost of the hedging program on these features? Could you highlight about that, please?
Yeah, there's a significant improvement in the U.S. that's caused by the hedging program itself year over year. About $50 million US dollars pre-tax before amortization of DAC, which works out to be about 20 million after tax after DAC, in excess of our expectations. That's being driven by lower volatility, which we've talked about before and which really helps us, and some gains in basis that we've been actually having on a fairly regular basis now. So that's the single biggest driver in the improved technical margin. Our mortality margins are actually also up on that, on the DB, and we've actually had pretty good mortality experience in the U.S. in our basic business.
Thank you, Stan. Any question coming through the web? Through the phone?
We now have a question from Nick Holmes. Please go ahead, announcing your name and location.
Yes, hi, it's Nick Holmes at Lehman. I had a question on unit linked, please, which is, I wondered if you could update us on how you see the demand for unit linked products at the moment, and whether the 49% of AP in unit linked looks sustainable. In particular, I wondered whether you could give us some additional comments on Twin Star in Germany. You said it's going well, but I wondered if you could give us a bit more colour. And unit-linked sales in France and the US, do you see those as coming a bit under pressure because of the recent pullback in equity markets? Thank you very much.
Okay, Nick, we'll try to answer the question. It was very difficult to understand what you were saying for technical reasons. We understand the question is about the unit-linked sales and the new unit-linked products. Stan and Denis are going to try to answer it. Do not hesitate to re-ask your question if we do not handle it properly.
Yeah, so if I'll start if you want, Denis. Yeah. So, Nick, on the U.S., was that to me or to the person with the mic?
No, it
okay.
was to the
Okay. Down, Stan, down. So in the U.S., basically, we've been gaining market share with our Accumulator 04 product for the last 5 quarters, ending with the first quarter of 06. We grew sequentially over what was a record quarter for us in the first quarter of 06. We grew 5% in the second quarter of 06, which looks pretty good. We don't have full industry data yet. We do know that a couple of the peers have actually reported stronger sequential growth, but I think when we're all finished, we will still have maintained close to a 9% market share, 8.5% to 9%. So I think that's very good in the U.S. and we've just introduced a WB for Life product, which is now available in the U.S., but was not during the second quarter. So basically now we sell, I think we and the Met are probably the only two carriers that offer both a GMIB as well as a WB for Life, and I don't see any way that that can hurt our sales. We don't see any competition around margin, and really have not, and that's really been stable for quite a while, and I think that's a big positive. And if the question was on TwinStar, I mentioned that we had 5.6 million of new business value on roughly 10 million of APE, so very high new business margin, which is a function of interest rates again, and the current economic environment. And again, I would emphasize, Nick, that that's really not an assumption. It's just a reflection of where the market is at the moment. So TwinStar, I think, has actually had a pretty encouraging, as I think Henri and maybe Denis just both said, and I did before, an encouraging launch. And Denny might want to add to that.
Yeah, I will add two points on TwinStar. Yeah, I will add 2 points on TwinStar. The first is that our launch was quite successful with our proprietary distribution, and more so than with third-party distribution, which remain an opportunity for us. Secondly, that the product exists in two flavors, one single premium and one regular premium, that the regular premium is selling very well, and we have not seen a take-up of the single premium that much, and this is related to what I just said, because we expected that third-party distribution would be selling more the single premium product, and this is the opportunity going forward.
Nick, did we answer your question fully?
Yes, that is very good, apart from just one additional point, which is the 49% of APE that you have at the moment, unit linked. What is your feeling about that at the moment, going forward?
Can you speak a little more distant from the mic, if you can try, because we can't hear you at all.
Can you hear me now?
It's
Hello?
Better.
Hello, can you hear me now?
Yeah. Okay. I think we got it. I think I got it. Okay. Nick, I'm going to try to tell you what we think we heard. Okay. And then just try to say yes if it is, because the connection's horrible. We think we heard. What do we think about the 49% unit-linked portion of APE? Is that sustainable? Can it go higher? And if that's the question, then I will give a view, and Denny might enhance it. Is that the question?
That is the question.
Good. So, okay, I think the answer is, with respect to what we're trying to do everywhere in the world, that yes, we think we can increase that. I mean, I think what we're seeing in Germany is the beginning of that. That's exactly what we've been trying to do in Japan, and I think that it's off to in France. And in France. In Japan, it's off to a slower start. We've talked about that, but I'm still very encouraged about it. It's the right product, and it will take off. In France, we're working on it. In the UK, we're working on it. And again, in Germany, we've had a promising start. So I think that around the rest of the world, we're going to see that. And by the way, one other thing I would add that I meant to say in the new business value presentation is that to the extent that that happens with the secondary guarantee, the phenomenon that you've seen in this period where risk-free rates increase and new business value increases would actually take place everywhere else in the world. It's not taking place because we don't have those kinds of unit-linked products yet in place, but once we do, particularly with secondary guarantees, they will have the same sensitivity to rising interest rates, which I actually find interesting, by the way, because as you know, when interest rates go up, our stock tends to get hit. And in fact, what we're showing to you is that when interest rates go up, it's actually good for our business. And then the last thing I would say, Nick, is the U.S., we've been increasing the unit linked on the annuity side, but there's a lot of room to increase the unit linked on the life insurance side. And we launched one product earlier this year which has showed promising sales, but there's a product that's more oriented towards protection in the life business, but is a variable life product or a unit-linked product that we're launching in September. So I would actually expect that we will see more unit-linked life sales in the U.S. It's hard to imagine that we could have much in the way of more unit-linked annuity sales, because we have virtually all of our annuity sales now are unit-linked. But I think there's lots of room on the life side.
Thank you, Stan.
Thank you.
Other question on the phone?
Our next question comes from Mark Cathcart. Please go ahead, announcing your company name.
Deutsche Bank, Mark Cathcart. Can you hear me?
Yes, Mark, you can go ahead.
Cathcart, Deutsche Bank. You can hear me okay? Got a few questions. First one, I just found that the Q2 US new business margin rocketed by about, I think it was about 11 points. I don't know if Stan still looks ahead now that he's leaving, but was this just like a Stan Tooling fireworks display, or is this really a sustainable margin on a going forward basis? In other words, the 27% new business margin, can you really see that being sustained in Q3 and Q4 and thereafter? Second, in Japan, obviously there's concern that Japan has gone ex-growth. To help us work out whether it's growth or no growth, I wondered if you could give us a split of the new business profit being generated by the 4 core products being sold, and what your view is on the growth prospects of those 4 core products. If there's only 3, I apologize. Next point is Twinstar generated 6 million of new business profit in the second quarter in Germany based on 10 million of APE, so a fantastic new business margin. Is that sustainable? And if, for instance, in the third quarter, Germany was to write 20 million of APE, then actually you'll be generating more new business profit from your APE Twinstar than you do in the whole of Australia. I just wondered, it just seems rather odd that Twinstar is so profitable, and what your growth outlook is for Twinstar, if indeed it's just going to explode on these fantastic new business margins. And the final question is the beta of your share price, which I know you're keen to get down, and the volatility. Acquisitions, I don't think, help the volatility and beta of your share price. I just wondered if Henri could tell us what his view is on acquisitions at AXA on a going forward basis, if the message delivered today would be the same message that was delivered at the beginning of January or halfway through last year. Thank you.
Okay, you want me to take the first 3?
Go ahead.
Yeah, so I'll take the first 3, I think, and then Henri or Denis can jump in on and add and talk about the acquisitions. I note, Mark, that I've improved from making up the assumptions on the train to simply having a final fireworks display. So yeah. I think I'm going to take that as positive. But in answer to your question, I think it's quite sustainable. I will tell you, with respect to the U.S. margin, what it's dependent upon, and what drove it. I mean, if you look at what drove our margin over in terms of the most recent change, it's interest rates, which are quite real, and that piece I can't control. It's mix, and that we can improve, and I think we will improve. And so I think that's not only sustainable, I think it's improvable. And then finally, we're going to have pickup from both volume, and volume won't impact margin, but volume will drive expense. And we have expense improvements, unit cost reductions, if you will, that are driven largely from volume, that will help to improve the margin. So I think it's quite sustainable if the economic conditions stay the way they are. And that is, in fact, what drives, as you know, the risk-free rate, and what drives the calculation of the new business value in the market-consistent world. So, you know, that's unpredictable, but other than that, I would say that it's quite sustainable. And the things that we've been doing with respect to mix are quite real. And I think if only, we've got an entire company oriented around that improvement. With respect to Germany, I think it's the same answer. The Twinstar margin is something that we vetted through the group process. We were involved in the pricing of it, but I know, and in fact, even before we went into this meeting, I actually checked on the numbers again and got sure that we're all entirely comfortable with it. That margin is real. It's tied to the current conditions with respect to interest rates, shape of the yield curve and the interest rates. And I think to your question, if they double the amount they write and the interest environment stays the same, they may too have expense economies that actually help to increase it. But they certainly won't be reducing it. And yes, I think you're correct, that at least with your arithmetic, that if they did that, they would pass Australia. And then finally, with respect to Japan, if I understood the question, I actually think about Japan in terms of new business value margin on 3 different kinds of products: life, health, and investment and savings. On those products, the margins right now are about 33% on the life product, down somewhat from where it was a year ago. 156% on the health product, up somewhat from where it was a year ago, but with volume down. And in the investment and savings margin product, it's actually a 51% margin. So, you know, those are the margins. Now, where are we going? I think we're going to sell less health, I believe, more life and more investment and savings. And as we've been saying, I think for years now, I think what that will do is drive a smaller new business margin in Japan, but one that I think is probably sustainable. And by the way, I don't think, and my guess is that neither Henri nor Denis think that you could grow any business the way we've been growing Japan. The growth rate in Japan's been 50 or 60%. The new business margin has been 50 or 60%. That is great, and it's actually driven the kind of value that you're now seeing manifest itself in underlying earnings. But if Japan can continue as it is to be a strong double-digit performer with a good double-digit NBV margin, I think that's very good.
I just want to add two points on Germany and Japan. On Germany, I told you that the bulk of what we sell in terms of Twin Star is in regular premium product. We would have a lower margin on the single premium product, as you would expect, and depending on the mix change, the margin might change. Second, and we hope to be successful in selling the single premium, so that would have a slightly lower margin. On Japan, the growth in new business value was 14%, and we are still aiming for a growth in new business value of 15% per year. What happened in the first half was that there was a strong deceleration of the long-term accident product, the LTPA product, which was hit, as Stan mentioned, by a significant tax change, and a gradual ramp-up of sales of term product, which we expect to continue to be successful, and less success than we would have expected on the investment and savings side, and we would expect that over time our venture into bancassurance will be successful. And on the medical side, we saw a slight decline, but certainly less than our key competitors in that channel, and we believe that we have reason to believe that we will keep or even grow our market share there.
Stan? Yeah, the only thing, Denny's point on Twin Star is important. I think the one thing I would add is that we know that the German Twin Star product is actually more profitable than the U.S., so where we do almost all single premium. And the U.S. new business margin on our variable annuity is somewhat more over 30. So it would be less, but it would still be very significant. And I want everybody to understand that.
I just wondered, Stan, seeing the explosion of new business margins in second quarter based on the current interest rate environment, where you're saying that the new business margin may actually get wider if interest rates go higher, isn't that going to invite competition?
Well, that's a great question, Mark. I mean, so far it hasn't. As I've said, we've been, we have not seen it in the U.S. There's plenty of competition in the U.S. right now amongst, I would say, the top 10 carriers, but it's all around features and functionality, and it has not been around price or margin. And it's been like that really for 6 or 7 years. And I think the barriers to entry are high enough that, that it's unlikely that we're going to see carriers wanting to take more risk or to accept lower margins. I think we're making reasonable margins. I don't think they're unreasonable, and I don't expect to see a change in that.
I'm just pointing out that basically your margin went up by 70% Q2 versus Q1, so that must generate some interest. In Japan, bancassurance has been a bit of a flop, I understand. You've had tax reductions on life products, and health is going down, so I still can't see why we can expect growth. I know you're looking for 15%, but the tax angle's got less beneficiary. It's actually got penal. Health is moving in the wrong direction, and bancassurance doesn't really seem to be happening. So just wondered if you could give us further delights that could come through in Japan, and what can give us confidence.
Mark, I think it's, we like the question. It's a very technical one, but we'll handle it offline if you agree, because we have other questions in the room.
Sorry.
To answer your question on the share price, it's an interesting one. Really. I'm slightly frustrated because there is one satisfactory thing, which is that in the long term, the AXA share performance is a great one when compared to the sector. I mean, in fact, if you look over 5 and 10 years, you have 2 players which are distinguishing themselves from the others. It's ING and us. So that's the positive side of the news. What's frustrating is that at this stage, the level of the share price is lower than what it was at the peak, at the time where the combined ratios were 20 points higher on the property casualty side, where the operating earnings were 1/3 or less from what they are today, and where the new business value was approximately 1/3 of what it is today, and when the organic growth was 0 or less. So it's slightly frustrating to see that. I think the market is undervaluing the sector because the 2000-2003 turmoil has generated a lot of confusion. In the long run, I'm quite optimistic that this is going to correct itself. As far as the volatility of the AXA share price related to acquisitions is concerned, we have learned to get used to it because every time we do an acquisition, the share price starts by going down. People start by saying that we've paid too much. And generally speaking, 2 years later, everybody thinks the acquisition has been great and there was no reason to see the share price going down, and the share price is significantly higher than before. So,
but then it goes down again because you make another acquisition.
Sorry?
I said then it goes down again because you make another acquisition.
Yeah, no, but we are reasonable people. I think we've now, all of us, been in charge for a sufficient period of time to have created a track record. And I think the anxiety linked to acquisitions is excessive. I mean, you know that if there are real opportunities which are accretive to the share price and generating some long-term strategic advantages, we will, I would say, try to acquire these businesses. But you also know that if we think these are things which would be too risky or would create too significant integration risks because our hands are full, we wouldn't do it. So
I guess the question is, given the
Mark,
Winterthur acquisition,
we have a lot of questions in the room.
Basically, if the appetite is still as
be
great
nice.
as
I
it was
think
a
we'll
year
see
ago,
you tomorrow in London, but
sure.
I'd like to give some time to the people who are in the room.
Is the appetite for acquisitions as much, though?
Okay, in the room. Yeah.
I think I'm offline now.
Yes, I have just one question about the UK life market. You still have a quite low margin on this market. There's a question of the competitive environment in this market. Do you think it is still possible to imagine to have a kind of reversion to the mean on the new business margin published by AXA, I mean to 15-20% on the medium term, despite perhaps an increasing competitive environment on this market?
Thank you. I mean, in the UK, we think the situation is progressively getting better. We still have a significant amount of work to do to enlarge the distribution and to regenerate the product range. But it's probably the market where the regulatory environment is the most business unfriendly as far as margins are concerned. We've been starting to see some signs of a reversal over the last, I would say, 18 months to 2 years, but it's fragile. Overall, I think the factors for optimism are the fact that we are regaining ground from a, I would say, market share standpoint. The new products have better margins. And if you look at the market as a whole, and it's something we've already said many times, something like 25 or 30% of the market are in runoff, which is leaving room for the remaining players to increase their share of the market. And we think that there could be further restructuring going forward with some players who do not necessarily have a long-term interest in staying invested where they are invested. So given the size of the market, given the professionalism of the market, and given our position, which is the fact that we have the strongest balance sheet in the industry in the UK, with probably the highest capacity to generate new products, we think it's worth to stay there, to continue our efforts, and to, I would say, expect an improvement for the years to come. And Nicolas Moreau, who has taken charge now for a little more than a month, is working hard with the teams to improve the picture. Given his track record and given the energy of the team, I'm quite optimistic that we will see some positive outcomes in the years to come. Denis, you want to add something in the UK?
Just one small comment, which is that the UK market had also suffered from irrational behavior on the part of the mutuals. The two largest mutuals, Equitable Life and Standard Life, have now become directly or indirectly stock companies, and that's probably another factor for rationalization.
Next question in the room.
Regarding Ambition 2012, I think you will make a point in a few weeks. But however, could you just give us an update regarding the way you will treat Winterthur within this plan in terms of targets?
I think, thank you for the question, because I want to dissipate any ambiguity there. The Winterthur acquisition is not, I would say, replacing any organic growth as far as 2012 is concerned. We will apply the 2012 disciplines to the Winterthur entities. In other terms, what we expect is to generate a growth momentum at Winterthur, or within the Winterthur operations which are going to be integrated within the group. We expect to, I would say, generate a growth momentum which has to be equivalent to the one it's going to be at AXA. And the way we describe the fact that any external acquisition is not diluting or reducing the efforts linked to 2012 is to say that what we expect is an earnings per share growth equivalent to what it would be without any acquisition. In other terms, it's applying the growth rates of the 2012 ambition to any further acquisition and expecting from the shares we would possibly create linked to any acquisition, generate for these new shares an earnings per share growth equivalent to what it is in the rest of the group. Is this clear enough? Any other question in the room? Are there other questions on the phone?
We now have a question from Andreas Schafer. Please go ahead announcing your name and the company name.
Hello, it's Andreas Schafer from Westlby in Düsseldorf. I have just one question on your asset management business. The cost-income ratio of AXA IM fell much more stronger than the one of AllianceBernstein, despite a similar growth in assets under management. Could you please explain why this was the case and probably give a flavor of how it would be in the future?
Sorry, I understand that your question is on asset management, but it was not clear. Can you repeat it?
Yeah, it was just a question why the cost-income ratio of AXA investment managers fell much more stronger than the one of AllianceBernstein, despite a more or less similar growth in assets under management. Could you please explain a bit more in detail why this was the case?
So what I understand the question is the improvement in the cost-to-income ratio of AXA IM has been more significant than the cost-to-income ratio of AllianceBernstein. This relates to the fact that on the AXA IM side, there has been a significant change in mix with the proportion of third-party business moving from 26% to a third, whereas the change in mix for AllianceBernstein, which is already more than 80% third-party investment management, has not changed much. In both companies, we have an improvement in the cost-to-income ratio. In AllianceBernstein, and it's coming from the growth in assets under management and hence revenues faster than the growth of expenses. This margin expansion is stronger in AXA IM with the shift to towards more third-party business. On the AllianceBernstein, there is also a margin expansion which is related to the move from US investment services to global and non-US investment services, as well as the growth of net inflows.
Okay, thank you.
Any other question on the phone?
Our next question comes from Andrew Crean. Please go ahead announcing your company name.
Good afternoon, it's Andrew Crean at Citigroup. I just wanted to ask a question on the investment margins in the life business. You, I think, indicated that there's a substantial increase in investment margins still to occur as interest rates rise, both I suspect in Germany and Japan. Can you give us some sort of figure work around that as to where the investment margin could get to, and particularly on the Japanese side, if you could talk a little bit more about those legacy reserves which are still on negative margin.
Yeah, if I'm understanding the question, Andrew, it's about investment margin in the life business. Yeah. Okay, and basically, if the question is where is it coming from, then basically, as I said, it's the U.S., the U.K. had a significant amount in Japan, which I think is real, and was really driven by a very small margin, and this is a reflection of what we've been able to do with the portfolio. And the gradual elimination of the albatross from the negative spread business. And in Germany, I think the number I gave you was from 36 to 44. That is correct. So that's a very small improvement, but I think one that we might be able to build on.
Yeah, maybe one more comment on Japan, where I mean the position in Japan is that we are in a normalized situation, in a situation of zero investment margin, but there is a quite significant allocation to alternative asset classes in Japan. I believe it's 9% of the portfolio, and those alternative asset classes have been very cleverly built, and we were able to realize gains on those portfolios in the first half, which are not necessarily sustainable.
The negative spread portfolio in Japan, how is that developing in terms of size? I mean, how quickly is it shrinking as it rolls off, and then you actively try and roll it off?
Yeah, I think Andrew, if we're following you right, the negative spread portfolio in Japan is over, essentially. I mean, we've accomplished the goal that we set out 3 or 4 years ago. And at this point, we're, as Denny just said, basically at a zero margin in Japan. So the huge negative spread is gone.
Did we answer the question, Andrew?
The negative spread for the portfolio, if we analyze it in a more granular way, remains about 6 billion euros, but it's offset by a positive spread portfolio. And the attempt to convert negative spread policies is almost complete, and we'll continue to convert small amounts each year, but it will not be a major effort as it was, and we have now concentrated the sales force on selling more new business.
And over time, as we always said, the rest of the negative spread will actually run off the books.
Great, thanks.
Next question on the phone.
Our next question comes from Michael Broom. Please go ahead announcing your company name.
Hi, it's Mike Broom from Morgan Stanley. I just wanted to clarify when we're looking at the new business profit numbers, how the assumptions underlying the first half numbers compared with assumptions underlying the first quarter numbers. My previous understanding was that there were some modest changes made to, assumption is the wrong word, but risk-free rates obviously at the first quarter, but also things like unit costs. My understanding is for the half-year numbers, some other variables have been changed as well. Sorry, go back a bit. My understanding for the first half was that you do things like unit costs and obviously the risk-free rates and everything. My understanding for the first quarter is you just did product mix. So therefore, when you're comparing a first quarter number with a first half number, you're looking at numbers that can't be compared because the assumptions underlying them are quite different.
Yeah, that's true.
Could you just clarify all that for me, please?
The way, essentially what you just said, Michael, is correct. I mean, the first, but let me just kind of give you first of all, you cannot compare the first quarter and the first half. So
when people start trying to back into
you can't do it.
Margin, that's a nonsense exercise. Is that correct? Yeah.
That is correct. Okay. And the reason is that for the first quarter, and I thought we described it fairly carefully, when we did the first quarter, all we did was basically take the 2005 factors for new business value and apply them to the volume that we had for, by product, if you will, for the first quarter of 2006. What we did for the first half is we reflected the economic conditions that were in place, as we would be required to under a market consistent valuation. And we reflected the mix, and in some of the world, basically everywhere except the U.S., we reflected the expense improvement. We did not reflect the expense improvement in the U.S., but we did everything else. But certainly the conclusion that they're not comparable, you cannot try to say, to take the difference between the first half and the first quarter and say that that was what was earned in the second half. That would be absurd.
No, absolutely. I mean, how you described it was exactly how I had understood it. It's just that I was a little bit surprised earlier when you were asked about second quarter margins that you that wasn't your first answer, if you see what I mean. But that's fine. Thanks very much.
Just to be clear, you cannot second guess second quarter numbers. We publish first quarter along the lines that Stan has described. We publish first half, but we are not. I mean, we are not quarterly filers essentially on profits. So you cannot guess the second quarter.
No, I appreciate that. It's just that the conversation earlier was maybe didn't appreciate what you've just described, but that's fine. Thank you.
Okay.
Okay.
Good.
Sorry for any confusion.
Next question on the phone.
We have a follow-up question from Mark Cathcart. Please go ahead.
Welcome back, Mark.
Just like to thank Mike Broom for educating me and possibly others in the market. In relation to acquisitions, I think you've got 2 billion euros of debt on the balance sheet, which you've not on the balance sheet, but excess debt capacity, which you've said you could use to make further acquisitions. Does this mean that you could actually make the 2 billion euro acquisition and wholly finance it by debt? Or as with Winterthur, would you be loath to go down or up rather to your maximum debt financing capability? In other words, you'd always want to leave some leeway on the balance sheet.
Okay.
We gave you the 2 billion. We gave you the 2 billion number as an indication. We have no current plans to make a 2 billion acquisition. And what we said was we wanted to keep some flexibility on the balance sheet, and I can confirm that today. I will take advantage of that question to answer a question that you don't ask.
Not been raised.
That had not been raised, but a comment that I didn't make during my presentation, and I wanted to make on the unrealized capital gains on equities. You noted that we've realized slightly in excess of 800 million euros of capital gains in the first half, and the question that you might ask is, I mean, Henri has said that we don't have plans to realize big capital gains in the second half, but have we depleted our portfolio for the future. And what I could tell you directionally is that our unrealized capital gains group share on equities at the end of the first half is only 400 million less than our unrealized capital gains on equities at the end of last year, after having realized 800 million plus euros of equity capital gains in the first half.
Thank you.
Do you have any other question, Mark?
I do, actually. It would be, I go back, it would be extremely useful to have a breakdown of new business profit by core products in Japan, given the growth dynamics of those different business lines.
Yeah, this is something we can handle offline if you agree.
Thank you.
Okay. Any other question from anybody else? Any additional question in the room? If no, thank you very much. We are going to adjourn the meeting, and we are going to make sure that next time it works better as far as the questions on the phone are concerned. Thank you very much.